Hi, I'm Leena Rao. Welcome to our Ask a VC show where we put VCs in the hot seat. We're joined today by Battery Ventures General Partner Brian O'Malley. Thank you so much, Brian, for
Thanks for having me, Leena. Appreciate it.
Going into your bio just a little bit before we start, Brian leads Battery's early and seed stage practices and focuses on investments in e-commerce, online marketplaces, and internet applications. Your investments include Bazaar Voice, Coupa, Bright Edge, Duetto, Serena and Lily, one of my favorites, Dollar Shave Club, J. Hilburn, Hotel Tonight, another one of my favorites, and Sosh.
Yes.
It's a lot of investments.
There's a bunch there.
Do you have time to do anything else?
Well, I'm here, aren't I?
That's true. So I want to start with sort of the topic du jour of the past few weeks, which is AngelList Syndicates.
Sure.
Highly disruptive, it seems like, for the investing world. What's your perspective on syndicates and how it's going to change your job or the way that you invest?
Sure. So I think we're still very much in the early days of how this will evolve. And there's several implications along the way. So the first one that some people have been touching on is that it's very different if someone's showing up for a $50,000 check versus a $500,000 or $1 million check.
That's right.
And so I think
because they could be leading the round in that situation.
Yeah, and so there's pros and there's cons, right? So now a group that used to be just kind of complementary, that you would always leave $250,000 to $500,000 to just include people, now all of a sudden those people might be showing up and competing against you. And so that's certainly relevant, and people need to be that much more confident of like how they're helpful to entrepreneurs and what their value proposition is to companies at that stage.
I think it would be helpful to understand, for any entrepreneurs watching this show, to understand what is it that a lead brings to the table that's different from some of the other investors you choose in a round, especially at the seed and early stage.
Yeah. So the big thing that I think people are looking for from a lead is they're the first person to step up, and they're the last person to leave. And so it's someone who's showing interest before anyone else necessarily shows interest. They're typically structuring the round, and they're typically the closest one working with the entrepreneurs. And one of the big hits that traditional larger venture firms get with seed investments is, do they have the time to really focus on that, or is that just kind of an option? And so as entrepreneurs look for who the right lead is for their seed round, it needs to be core to that person's day-to-day life that those companies are successful. Because for that one entrepreneur, they're not just an option, like that's their business, that's their daily life.
Yeah, I mean, and you're seeing more VCs get into seed and early stage, but they're not necessarily leads. Do you guys at Battery lead?
Most of the time in our seed investments, we lead, and we take our seed investments very seriously. We took a step back and ran the math, and our best early stage investments are those where we were originally involved in the seed rounds. And so I think a lot of people, for the last couple of years, it was kind of an afterthought that, look, we want this option value of getting in XYZ hot company. And for us, it really evolved into something where we get to really know how entrepreneurs think, we get to work with them, and that provides so much more data than just a 2-week kind of shotgun process can around a Series A to really know which teams are going to be able to go out and do what they said they were going to do.
Well, I'm also curious because, I'm not going to name any names, but you look at that list of the people who are syndicate leads, especially the ones who have huge backing. A lot of them have other jobs. Like, it's not that they're not solely focused on just investments. They either are VCs, or they're CEOs or founders or whatever it is. So is it realistic to expect that that person can be a lead for your investment and have that time?
Yeah, I mean, if I were an entrepreneur, that's one of the big questions I would be asking. If that person's day job is running a company, or if that person's day job is being a VC at another firm, the real question is, if things start to get tough, where's that incremental hour going to go? Are they going to go to helping you in your business, or are they going to go to their day job? And it's a very different relationship having someone at $50,000 where you can call them up and ask for a favor versus having them really be the lead in the round. And so, not only if I were an investor in one of those people's companies, and I now know that they're also doing the syndicate on the side, I would ask them how much time are they putting towards it. Same thing if I was a CEO of a company looking to work with them as a lead, I would want to know what's their time commitment, how important is this, and then how's that relationship going to evolve over time.
Do you see any traditional VCs like Battery or, you see Foundry, they created a syndicate. Do you see any traditional VCs going towards that direction?
Yeah.
Just creating a syndicate to kind of test out the water,
Sure.
see how it goes?
I see more VCs participating in some of these syndicates because at the end of the day, the biggest challenge we have is really managing our own time. And so just like you saw a couple years ago where some venture firms had these kind of scout relationships where they would put money in behind different people, it gave them a broader lens to look at the market. I can see some venture firms participating in these syndicates not because they want to make money in them, but because they want to get a lens into these companies.
Yeah.
The whole idea, in my mind, of creating a syndicate here starts to become a little bit of a conflict of interest versus my traditional LPs.
Right.
Where they're already paying us a management fee and a higher carry structure. If now all of a sudden someone can participate in those same deals, for no management fee and no carry structure, it's kind of like, who are you ultimately representing at the end of the day?
That's right. Yeah, it does kind of put
starts
LPs
to create a little bit of a
in
slippery
the back
slope.
end. That's right.
And when it's only $1 million or something like that, it's maybe not as critical of an issue. But there's no reason why these syndicates can't grow to become material sizes over time.
Right. Well, as you said, we're going to see, how this sort of shakes out, and there's a lot to be determined. I want to move on to one of our reader questions.
Sure.
So this reader obviously must be doing a lot of diligence on Battery, but his question is, most VCs consider deal flow from associates as guilty before proven innocent, whereas I'm happy to hear you guys just funded a company via an associate, and that was Blue Jeans Network.
Sure.
Can you tell us why you guys think differently and whether this is a conscious black swan farming technique and how it's been successful?
Yeah, I'll have to use that, the black swan farming. So we're a very kind of data-driven organization, and I think if you take a step back and look at Battery, there's a few things that we've noticed over time. One of which is the investments that start out from our associates actually have better returns. And typically that's because to get them through the process, those companies need to be just that much better versus someone who went to college with one of the partners and it's kind of a buddy-buddy relationship.
Right, and this is actually the associates are doing hardcore due diligence on these companies.
Right, yeah, and so the associates are showing up, and a lot of times the associates have the extra bandwidth to really play out a thesis, look at which companies are innovating, and pick the ones that are the best, and they need to show up with that level of thought process. So for us, a lot of times the associate deals are very well thought through. And the second thing is a lot of us actually started out at the firm as associates. So if you look at the general partners at the firm, 8 out of 9 of us started out as associates in the firm.
Really? So there is that opportunity to
it's rare, but at Battery, that's actually what's worked out. The people we've hired in from the outside, their performance hasn't been as good as the people that showed up in the organization and worked their way through. So I think naturally we respect the deal flow that comes from the associates that much more because we were in that role at one point. And I think for entrepreneurs, understanding how to leverage the associate is a skill that's not widely known.
Right.
And the associates can be your best friend. Now, you don't want to show up with an associate that's fresh off the boat, hasn't ever done anything. You can end up wasting a lot of time. But some of the more experienced associates that have done several deals, understand how their firm works, they can be a huge advocate and they can really pay off.
That's good advice. Our last question, we have a little bit of time left. VCs have kind of been fleeing the e-commerce world, it seems, of late, or there's definitely a dark cloud that's hovering over e-commerce.
Yep.
You seem to still be bullish on it, and you have a number of investments in that space. Why?
Yeah. Well, I mean, the venture firms are notorious for being lemmings and sort of chasing whatever's hot at any given time. And so I did a lot of software investing when software wasn't popular, and now those are some of my best companies. And so I look at e-commerce, and I think the underlying macro trends around people buying more things online, as well as the ability to create products and services that are unique that just couldn't have been done years ago in an offline environment, as still being very true and relevant. And I think a lot of venture firms are shying away from e-commerce because they made some bad bets and they're now coming back and haunting them.
Right.
And so if you look at our e-commerce portfolio, I think pretty much all the companies are doing incredibly well. And a lot of that stems from the fact that, it's less about what's the business model du jour. It's less about, is XYZ previous tech founder now doing their e-commerce startup. And it's more about how strong is the value prop to the customer, and really starting out with demographics, and then working backward through merchandising, and then working backwards through product. When I say product, I don't mean sort of the web experience, I mean the actual physical product that they're selling.
Well, I think you made when we were talking earlier, you made a really interesting comment about how subscription works for some forms of payments, but it doesn't work for others. And that's a huge model that's kind of been back and forth over the past few years. And so could you elaborate on that? Because I think that's an interesting
No, absolutely.
point.
I think like a lot of times when investors look at subscription commerce, they see, oh, this is great repeatable revenue. I can now look at customer acquisition for, via a lifetime value calculation. It's always easier for companies to kind of fudge really good lifetime value calculations. And so we look at subscription commerce through the eyes of the consumer. And does it actually benefit the consumer to buy the product through a subscription mechanism? And there are some things that we do every day that are subscription-based, things like cable, things like Netflix, things like telephone service, where if I had to re-sign up for my cell phone every month, that would just be a huge pain. And so that naturally makes a lot of sense for subscription. So the areas that we've focused on around subscription are products that there's a natural consumption cycle, where it's in the best interest of the consumer to have a new product show up when the last one ran out. And I think the ones that have had challenges are the ones that try to kind of, through a deal or through some sort of incentive program, essentially push the consumer into buying something via subscription that historically they hadn't done before. And you end up with this kind of issue where your best customers, you're actually leaving money on the table, and your worst customers aren't getting enough value, and so they're going to churn.
Right. Well, that's great advice for any of the entrepreneurs watching that are thinking of starting an e-commerce startup, or any ones that are currently founding one. Brian, we've run out of time, but thank you so much for stopping by.
No, this has been fun. Thanks for having me.